that's what you should spend your time doing, understanding what are the driving forces of the market that are more powerful than anything else, and that's the passive bid.
The Federal Reserve has cut rates to 4%, quantitative tightening will be over before Christmas, and Trump is about to make a trade deal with China. Is all of this going to be enough to kickstart another bull run, or is it a big top signal that means that everything is over and we should all just go home? Hello and welcome to Milk Road Macro, the podcast that knows that if the government shutdown has taught us anything, it's that it's easier to make peace in the Middle East than it is in Congress. I'm your host, John Gillen. Today is Wednesday, October 29th, and today we are joined by a legend of the world of finance, Bill Fleckenstein. Bill is a financial commentator, author, and hedge fund manager who is best known for his critiques of central banking policies and his highly successful short-selling strategies during the dot-com crash. Bill is going to break down the key takeaways from the recent Fed meeting and a whole lot more than that. So if that sounds good to you, make sure you like and subscribe and share this episode with somebody who needs to hear it. And as a reminder, Milk Road Macro is here to help. Macro's confusing. We're trying to fix that. Milk Road Macro's newsletter comes to your inbox twice a week, breaking down everything you need to know about what's important in markets that week. Comes straight to your inbox twice a week. If you want to get in on the alpha there, hit the link in our show notes to subscribe. We also have a pro report coming out this weekend all about the AI craze, the freight train that's going on there. So if you want to get our analysis on that, make sure you're getting our pro community. And without further ado, welcome to Milk Road Macro. Bill Fleckenstein, how are you, sir?
Fine. How are you?
I am doing really well. I'm excited to have this conversation with you today. I thought a great place to start would be with the Federal Reserve. We had the Fed's FOMC meeting today. They've cut rates to 4%. They announced that quantitative tightening will be ending on December 1st. And I thought a great place to start would be with your reaction to this. What are you making of this news? What do you think the market is going to do in terms of digesting this update in policy from the Fed?
Well, obviously, it was pretty well all telegraphed. The only surprise was the fact that Powell hinted that, or said that it basically wasn't a slam dunk to get a cut at December meeting, and the stock market had a momentary hissy fit. We'll see how long that lasts. I think the Fed has less to do with the stock market these days than does the passive bid, which is the driving force, as well as the other mechanical strategies that have risen up around that. So that's really the driving force on any given day. There's nothing about this Fed news that's either exciting or not or disappointing, because it's pretty well factored in. I guess if you had to have them tell you they're going to cut 25 in December, now it makes it look like it might be up in the air. I suppose that's slightly disappointing, but that's really reach considering almost nothing has mattered to the market from no negative bit of news or information that's really mattered. So, I mean, the FOMC meeting today is really kind of a non-event, if you ask me.
Gotcha. Okay. Yeah. And I think that's something that stood out to me from Powell's remarks too, was that he was a little bit ambiguous about the December meeting. I think his exact words was there were strongly differing views about how to proceed with policy among the Fed Board of Governors. What do you make of that uncertainty? I feel like that's been sort of like where we are from a macro perspective for a lot of analysts, right? Like people have been saying that we're about to top and crash, and some people are saying we're about to kick off a new phase of the bull run. So there are these very widely differing views. Where are you on all of this? What's the reason for this wide divergence in terms of like people's opinions about the policy path here?
I think most of the negative view has to do with the extraordinary valuations that you see in so many companies and kind of the market at large. So if you look at valuations, you look at other things like stock market valuation of GDP or speculative indicators like the amount of margin debt, those things are all sort of at levels that would make you be concerned. However, that's been the case for a while now, and it hasn't really made any difference. And the reason it hasn't made any difference is because the passive bid is what drives the market, and that's the number one variable. And it's the only thing that really matters, quite frankly, unless we get to a point where there's some radically negative news that wasn't priced in. We saw that happen last spring when all these, when the selling from certain people that could sell swamped the passive bid, and then it fed on itself, and we had that nasty short 15-20% break. I think the stock market that exists today and has for the last 15 years or so really has almost nothing to do with what came before it. It's all changed thanks to QE, which helped warp it, And then as the Vanguards and BlackRocks of the 401k investment funds became to dominate 50% of the daily trading, it's slowly but surely risen. I mean, that's the number one thing, and that's really in the big scheme of things, that's what matters most.
Okay, so
I closed down my short fund in early 2009 because the Fed began QE, and I thought that would make it rather difficult to make money on the short side, at least the way I did it. And while that was a good decision, I had no way of knowing, how good of a decision was going to turn out to be. That the market would basically be straight up for the next, 15, 16 years. And so while I used to focus on the Fed as the driving factor in terms of macro and catalysts for change and all of that, it is important, but it's second behind the passive bid.
Right. So I think this is something that I wanted to get you on here to discuss with our audience. Most of our audience are retail investors who are not really familiar with a lot of these institutional flows and may not know exactly what the passive bid means or why that's so important to particularly the equities market. I wonder if you could just explain a little bit about what the passive bid is, where it comes from, and why it's so important to understand if you're an investor.
Well, I can't really do as much justice to it as Mike Green can, who's the one that brought it to my attention about 5 or 6 years ago. But once he explained to me what was happening, and I spent time, following up on it and reading about it, and, everything makes sense in a sort of warped kind of way. And so what's happened is that, people that go to work in corporate America, they have their 401k plans and they're immediately defaulted into the stock market unless they can opt out. And so over time, and the passive industry, I mean, basically BlackRock and Vanguard have been able to make some changes in the laws that have helped skew more flows their way. But basically, you should think of the bulk of the money that goes into corporate America's target date retirement funds that people have in their 401k plans are all run by passive. And the reason why that matters is because back in the old days, when I was running money on the long side, worked for a kind of a conventional firm that I was a partner in, we ran money for companies like Boeing and Nike, big corporations. And when we would get we'd get a new account, somebody to hire us, we'd slowly build the portfolio up. Maybe there was a company that we'd owned for a while and it had gone way up in price. We're getting closer to selling it. We wouldn't buy that from them. In other words, we would make a decision over every buy and sell as to whether or not it made sense and how big the position should be based on the price and where it was in its evolution with what we thought was going to happen. Now what happens is every single day, BlackRock and Vanguard, if they get money, they buy. If they don't, they sell. Sorry, if they need money, they sell. But the really wild thing is it's a cap weighted index. And so if you have certain securities that by dint of having other people that like them start to get more popular and get bigger weightings, like some of these big tech stocks, then they have a bigger weighting in the index. That means for every dollar that comes in every day, they have to buy more. So the higher the price goes, the more that they buy. Kind of the opposite of what you would think is rational. And that's why you've got these extreme distortions with NVIDIA at a $5 trillion market cap and Apple at a $4 trillion market cap when their business has basically gone sideways plus or minus for the last few years. Fundamentals have no bearing on it. Unless you get into a bad environment where like all of a sudden the news is bigger than those flows and then if things starts to feed itself on the downside, then some of these valuations of the news matters. So the reason why this is so important is if you don't understand the rules of the game that you're playing, when something changes, you won't know what to do. So if you see people that are steadfast fundamentalists, as I have always been in my career, who aren't aware of this, they rail at the valuations and they're looking for a catalyst to cause prices to collapse around every corner. Yeah, if I didn't know this, I probably would have been doing the same thing. But that's not the environment that we're in. But you have to understand that the bigger this passive bid gets, the market share of it, as it starts to go from 50 to say 60, Mike's modeled it out, and somewhere around 60 or 65, things get exponential. But then the next thing that happens is it's a collapse, right? So there is going to be an enormous amount of pain on the backside of this. But as opposed to in the past, like around 2000 or the housing crisis, both of which periods I was short through, I could collect groups of catalysts and things like that, and I could try to make a guess as to when a time might be to get shorter. I have some specific information I was looking for. That doesn't work today. And so you have to be aware of this, but if something starts to change and this starts to spin out of control for whatever reason, you have to understand what that means and how you're going to react and be more defensive. So that's why you have to understand it. And so, somebody can go find, you can get Mike Green on the show, or go listen to what he's had to say at from some YouTube prior broadcast. But it's you just have to understand it to understand why the market's working the way it is and what may happen down the road.
Right. I really appreciate you giving us that insight on that. And yeah, like I'm familiar with Mark's work, but I think that you've also been really vocal about this too. And just like you said, that if the rules of the game change, you have to update your perspective so that you stay relevant. Right.
They
exactly.
have, and they will again. So, and on the other side of that is going to be really ugly.
Right. Well, so I want to ask more about your market positioning or your portfolio positioning, your market outlook, but I want to keep on the Fed here for just a little bit longer because I have some more questions for you on this subject. The rules of the game used to be different. The Fed used to have much more power in the markets. Secretary of the Treasury, Scott Bessent, has said he wants the Fed to be less backwards looking and data dependent and more accommodative and forward looking. He's made a comparison to the way Greenspan managed the Fed and interest rates in the 90s. You wrote a book, or co-authored a book rather, called Greenspan's Bubbles, The Age of Ignorance at the Federal Reserve. What lessons from the Greenspan era do you think that we should apply to this time? What do you think of Scott Bessent calling for Powell to behave more like Greenspan? Are there risks there? Do you think that's a wise policy path? What are your thoughts on this general conversation around this? Well,
Greenspan was the architect of the disasters that led to QE. His irresponsible policies in the late 90s led to the bubble that ultimately burst, and then led to QE. Then they started easing again, not learning their lessons from the prior bubble, and they created the real estate bubble. They were supposed to regulate the banks. It was a deal that was cut when Greenspan helped get Glass-Steagall repealed, and they did a poor job. So next thing you know, we get to the real estate bubble, and the banks are levered, they got 3 or 4% equity. They're levered 25 or 30 to 1 on their balance sheet, and they've got off balance sheet special investment vehicles, and they own all the garbage that they were selling. None of us who knew that the real estate market was a bubble could figure out where all the bad paper was going. And guess what? They were repackaging and buying it themselves. So then the Fed was wrong in two ways. They created a bubble. They advocated for real estate. They were saying that real estate, Greenspan, it's in my book, said, well, real estate can't be in a bubble because it's not arbitrageable. You can't sell in Portland, Maine against Portland, Oregon. He actually said that. But it was stupid. Made cheerleading people, and everyone said, no, real estate never goes down. It was all bullshit. And so then, now we've had never-ending rounds of QE. Bernanke was wrong when he said ending QE or QE could run its course. QE could turn into QT and run its course and be like watching paint dry. Well, it turned out not to be like watching paint dry. As we've had a couple of nasty reactions when they've tried to run the balance sheet down. Now they're giving up. The balance sheet's $6.6 trillion. So QE was a failed experiment, other than it helped boost asset prices. And in that era, when that was happening, then we had the passive bid, and now we've got this warped beast that we call the stock market. I don't know if I answered your question, but I went off on a tangent. So,
well, I'm just trying to get your thoughts on some of these like lessons from the mismanagement under Greenspan and how that might affect us today.
Yes, Scott's a very smart guy, but I think they came in and thinking that Doge and all this, they're going to cut all these programs that they're going to be able to skinny the government down cut some debt and cut the deficit, and then try to grow their way past it. And the tricky thing was going to be getting the bond market to sit still while they ran monetary policy and fiscal policy hotter than probably should be, given the other variables. And they realized they couldn't cut, and now they're just full steam ahead. I think he's a smart guy, but I think they've looked at it and said, look, we have all these problems in the country, and we have all these problems with the balance sheet, and we want to fix them. And if we try austerity to fix them, we'll get booted out in the midterms and nothing good will ever happen. So rightly or wrongly, they've decided, okay, we're going to run it hot and see if we can grow past all of our debt. Basically, we're going to try to inflate our way past the debt. Now, will they get away with that? I don't know. That's why I've been so interested to see how the bond markets behave. Well, in the last 15 months, short rates are down 150 basis points. And as of today, let me just look. I got this here. 10-year rates are up like 25. So 10-year rates the 10-year rates came down. 10-year rates are now 25 or 30 basis points higher than they were when short rates were 150 basis points higher. So short rates came down 150 and 10-year rates went up 20 or 30. That's a lot of easing for the bond that the bond market hasn't sanctioned. When I say the bond market, I mean 7 years and out. So the 7-year, even the 7 years up a freckle. So basically the 5 years is the inflection. So 5-year rates are exactly where they were. Everything longer than 5 is higher, and everything else is down lower. Why does that matter? Because if the bond market, the long part of the curve, doesn't believe the Fed's pursuing the right policy, and they're doing things to create more inflation that obviously longer term bond holders don't want to see, then you have a situation where the Fed's hands get tight. They try to cut and the rates back up. And then you have a problem because that'll feed back into a lot of other things that start to break. Then how do they ride to the rescue? They can't, because otherwise it'll make the problem worse. So then you get into the Fed wanting to do yield curve control. Now, Powell would never do that because he hates Trump, but Trump's going to soon have 3 people on the Fed, maybe 4. And then ultimately, I think they're going to try yield curve control, because the bond market is what's going to be when you pursue poor macroeconomic policies. Look, I'm bullish on America. We have a great country. We've pursued bad policies. We've gotten away with it for a very long time. And when you pursue bad policies, usually either your currency gets weak or your bond market gets weak, or both. It's hard for the currency market to get weak when all the other colored paper is run by countries that are just as bad off as we are, if not worse. And so I think that ultimately they're going to need yield curve control, and the Fed will do that. But I'm getting a couple steps ahead of myself.
Well, yeah. Well, so
do I think they should have cut today? No.
Okay, well, let's maybe deal with that. So I want to bring some of these pieces together for the audience. Like Powell has said in his remarks that there's no risk-free path for the Fed, and that they're kind of balancing between risks to upside inflation and downside on employment, and trying to find a path that kind of balances between these things. And he's referred to these rate cuts as risk management cuts. I think you just said you think they're pursuing the wrong path. We can come back to that. You can expand on that if you want. But this idea of yield curve control was something else I really wanted to talk to you about, because Stephen Mirren, who has been recently appointed to the board of governors of the Fed by Trump, has said that he believes that there is a third mandate for the Federal Reserve. So the first two being, controlling inflation and then keeping employment high. And the third one, he says, is moderate interest rates, which implies yield curve control, and it means that they're trying to explore that. But I'd love for you to share your thoughts on what that actually means, because there are a lot of ways that the Fed could, quote unquote, control the yield curve. But what policy path do you think they might go to that they haven't already tried?
There's really only one. You got to say, look, pick a number. 7-year rates. 7-year rates. We're not going to allow 7-year rates and longer to go above some percent. And you just stand willing to buy all the ones that want to get sold there. It's basically unlimited QE. We had yield curve control in the 40s and 50s between the World War II and the 51 or so, somewhere in there. And of course, Japan's done it. They monetized half their debt outstanding, took their debt to GDP, because I'm assuming the bonds that the BOJ owns are never going to get sold. So they took their debt to GDP from 300% to 150%, which is about where we are. but I think that's what they're going to have to do. They're not going to tell you now because they don't have to do it now. And but I think eventually they're going to be forced to do that.
But this is why, you talked about why you've been watching the yield curve, and everything longer than 5 years is the pivot point, and it's starting to go up. And so at some point they might lose control and have to do that, but they're just not talking about it right now. So that's helpful. So you said that you think this is the wrong decision to cut. The market, it seems to be in strong consensus that it was expected and maybe is the right path. Why do you think this is the wrong decision to cut here?
Well, if it was the right decision to cut, don't you think the bond market would have agreed with it? We've now cut 150 basis points, and the bond market has gone nowhere to up in yield. So the bond market is saying, we don't agree with this. Now, is it because of inflation or too much supply? I don't know. But look, just because you want to cut rates doesn't mean you can. I mean, at some point, when you spend 2 or 3 decades piling up incremental policy mistakes, you run out of good choices. And so they act as though that none of these bad things are lurking out there, and they're cutting rates. If we had been pursuing a sound policy and didn't have the debts we do and the debt service, and the size of the deficit, all things being equal, when you look at the economic landscape, you could say, well, yeah, maybe a rate cut's okay, but that's not the hand we have to play. There's a lot of other variables that come into it. But they figure they're going to own the Fed, and they can make the Fed do whatever they want. I'm talking about the administration now. And so they're not really worried about that. And, Powell's going to be out the door pretty soon, I assume. I don't think he's going to stick around when he's no longer Fed chairman, just to spite Trump. So, we'll see how it goes.
Yeah, I'm actually interested to see what happens with there too, because a lot of people don't know this. Jerome Powell does not have to leave the Fed just because he's no longer chairman in May. He could decide to stay on and gum up the works, but a lot of people think he'll leave, but we'll see what happens there. I want to pivot to something you touched on before, your portfolio allocation and your market outlook here. You've described some of these concerns in the bond market, the passive bid in the equities market, and sort of the situation that the Fed is in. But I've heard you recently, you've characterized your portfolio position as defensive. You've been somewhat in cash.
No,
go ahead.
Not defensive. I just have a lot of cash. The things I own would never be considered defensive securities. If you have gold and gold miners, those aren't exactly defensive securities. They may do well in bad periods because people are looking at what the government and the Fed's response to the bad period will be, which will benefit the metals because it's bad for the currency or bad for inflation of all that. So the things that I have are pretty volatile and have a lot of idiosyncratic risk, but they're not defensive by any means. Besides, I want to have cash because of these problems and because of Trump, because, as we've seen, although not so much lately, he makes up his mind about one thing, puts out a tweet, the market gets slaughtered, changes his mind. I mean, the amount of noise that hasn't been too much recently, but, by next week we could have another flap with China and, and so I just feel better having cash because the individual securities I have, while I think they have tons of potential, they have idiosyncratic risk. And I just feel like I don't mind having those individual securities if I have enough cash to feel like, okay, something bad happens, I got plenty of cash and I can use it if I want to or not.
Gotcha. Okay. So maybe this is kind of skipping around a little bit in the questions I had in mind, but let's maybe talk about those positions. You've said that, correct me if I'm wrong, but I think you've said recently you've been looking for investments that are not tied directly to GDP growth and sort of an all-weather portfolio that you've referred to as rifle shots. Right. Could you just elaborate on,
Sure.
what that means? Yeah. And give us an example so we can understand.
So I own a company called Pure Cycle Technology. I've been involved for the last couple of years. And what they have developed, which they licensed from P&G, is a technology whereby they can take polypropylene and take used, post-consumer, as people like to call it, and completely circularly recycle it. They get the whatever impurities or whether they're colors or whatever out, other impurities, and then they have plastic that is just like virgin plastic. It's a completely circular recycling process whereby they melt down the polypropylene using a complex process that uses a fancy form of butane, blah, blah, blah. And it came public via SPAC during COVID, and the original CEO and some of the designs didn't quite work, and they brought in a new CEO. He's done a terrific job, and now they are in the process. They've demonstrated the plant works. They've got they've got 17 or 18 trials that are in late stages where they're expecting to start getting purchase orders, and they've got another group of other ones behind that. They've got some orders. What I think the market is waiting to see is someone like, P&G or Mars or Pepsi, some big consumer products company, to give them a contract. Then that will validate in the people's minds who haven't maybe done all the research that I've done and other people that are involved, comfort that, okay, this really does work. I mean, it works. It's not debatable. So we're just sitting around waiting for them to be approved to start getting purchase orders. P&G is reserved. Part of their contract is they get 15% of the output from their initial factory in Ironton once they get the things rolling. So the certain states and various countries have mandates about how much plastic has to be recycled. And there are various different ways to do it. There's mechanical, which you kind of crunch it up. There's melting it down and then reprocessing it. This is just a complete circular dissolution process. It's really pretty slick. And the beauty of this is they have an immense opportunity because there's no competition. There are some wannabes, but no one doing what they're doing. And their first factory is ready to go. The next factories will be bigger and cost less. They've got one that's going to be opening up in Thailand. In any case, what you have is a company who's got open-ended growth with a barrier to entry and therefore protection of their margins. Their cost on this is not that far from what plain virgin is. And so it'll be price competitive. It may cost a bit more, but some of these companies have, like in a bumper, it might add $10. And I think the cost of a bumper is, I don't know, $100. This is going off the top of my head. In other words, the cost, in a car, $10 extra, when you have to meet, if you're an auto company, you have to meet a certain recycling factor based on a government edict, that's no big deal. So what I like about it is their business will grow and march on regardless of what happens in the economy. The economy is not going to make any real difference to their basic business. Okay. And that's the kind of thing I'm thinking of. I have a couple of other ones. But that's what I'm looking for, where it doesn't really matter if the economy is strong, fast, inflation's high, low. It's like they got a path to growth that has nothing to do with all of these other things. That's what I'm looking for.
Yeah, so I want the audience to understand as well, this is not in any way an endorsement or a recommendation or investment advice in any way, but it just wanted to kind of have Bill kind of explain his thought process and how he's approaching evaluating investments in this market. Yeah, so I think that's the lesson. Yeah,
that's what an idiosyncratic idea that's got barriers to entry, doesn't need those are some of the characteristics.
The way you're thinking about it, right? Very helpful. Okay, so I want to ask you about gold. Gold has been on a historic run this year. I think you were very early to this as an investment, and you were also very early to get in on gold miners. And I want to ask your thoughts on this because gold has obviously been pulling back in a correction here. Do you think that the move in gold is over for now, or are you expecting more upside? And do you think that miners or gold itself are going to outperform going forward from here? Like, what are your thoughts on where we are with gold right now?
Well, gold is a particularly difficult security to try to analyze because there's no fundamentals. There's no real data. We know roughly what it costs the industry average gold miner to produce gold. We can say it's $1,300, $1,400, $1,500 an ounce. But beyond that, it's not like, let's say we're interested in a retailer. We can do channel checks. We can see what the traffic's been like. You can monitor. You can figure out ways. Lots of companies you can figure out ways to try to monitor how the business is going. The executives of the company can have a strong opinion about how something's going to roll out. Well, no mining executive knows where the price of gold's going to go. No one does. It's not knowable. we all pretend, we look at the charts, and you can sometimes get an edge because a certain chart pattern looks in a certain way that tends to create a reaction that's basically psychological that makes this, that, or momentum and things like that. But so if you can get the direction right, you're doing really well. So if you're looking at gold mining companies, so there aren't a lot of fundamentals we can look at, but we can look at shifts. In the early 80s, when I got in the investment business, it was the tail end of when everyone was, a prudent portfolio should have 5 or 10% gold. Volcker broke the back of inflation. Gold was a poor asset for 20 years after that. And then when the bubble burst and Greenspan's lunacy started to get exposed, then gold started to do better. And it's done better at every iteration of the Fed making mistakes. And now we have a situation where, gold is now, is gold a currency? Is it a store of value? Is it a safe haven asset? Well, it's kind of all of the above. And it takes on different characteristics at different moments in time. Once the Western world confiscated Russia's gold during the start of the Ukraine war, that kind of kicked off a new leg. And now you've got various central banks buying it. Asians have been big buyers. Indians have been big buyers. Americans have not been the driving force behind this. And you can see it. I think the GDX coming into this year had a $10 or $12 billion market cap. We had $3 billion of net redemptions out of the GDX, the ETF. So there's been no real public participation in any meaningful way in gold or gold equities, measured by the things you can measure. Like interest in the ETFs is a good way to get a handle on it. And so gold miners, while a lot of them have done really well running what are tough businesses, and they've put up good numbers, they didn't really get any love until the last 6 or 8 months. Now we're having the first nasty pullback since gold had this most recent run off the spring, wherever it was in the spring. So it's a particularly so gold's hard to find a price and have a good feeling about. So you got a mining company, and you can look at all the variables about the mining company, but then a lot's dictated by the price of this gold, which is hard to pin down. So it's a frustrating, difficult area to really to get your arms around, because there's no real, tangible thing you can get your arms around like we can. Like I could talk about Pure Cycle or a couple other companies all day long about what I'm looking for this and that, everything means. That doesn't exist when it's gold and gold miners. So it makes it hard and kind of frustrating. And then and then there's all kinds of crazy stuff about gold being suppressed and silver being suppressed. I was the lead director of Pan American Silver from 1996 to 2011. Silver went from $4 to $40. Pan American went from $4 to $40, and I retired off the board thinking, okay, it's not getting much better than this. Unfortunately, that was about the time that big 3 or 4 year correction happened. But anyway. So it's difficult. And so I have some rules. If I'm going to be involved in a gold mining company, I want them in good spots, like the US or Canada. I want gold mines that have high grade, and I want them to have growth potential within their own properties. And when you start to narrow the list down like that, there aren't a lot of choices. My favorite choices are Agnico Eagle, Alamos Gold, and Wesdome. I own all three of these, and I have for some time. And there have been some others I've owned, but they are the three that best typify the rules that I have for what I want to see in a mining company. I probably got off on a tangent, told you more than you wanted to know, but
no. Well, so I this is kind of what I wanted to get out of you, is a little bit of how you're thinking about not only gold, the asset, but the miners. And, so, okay, I'd like to bring this back towards a bigger picture here, because, again, just for our audience, none of this is an endorsement for financial advice or investment. It's just like Bill's thoughts and how he approaches this. But what you've described, Bill, is a lot of very idiosyncratic investments and then idiosyncratic risks associated with them. I'm curious your thoughts about those risks versus the risks of just being in the market while we're seeing a secular bull run continue. You have a large cash position, so does Warren Buffett. A lot of people could say hey, the passive bid is going to keep driving equities higher. The Federal Reserve is cutting rates. They're ending quantitative tightening. Trump's going to make a deal. Why not just, isn't it a bigger risk to stay in cash rather than just getting into the market overall and just let that carry you higher? How do you think of that versus all this idiosyncratic, specific stock picking?
to be pejorative about it, you gave the perfect greater fool theory, right? Don't worry, it's just going to go up, and and I'll sell. I mean, look, it may work out that way, but you have to remember, when you're running a portfolio or you're running your money, you have to make decisions, every day, every so often, about whether to buy or sell, and that you have to fight your own psychology. And so if you're so stretched out, so invested, that something bad happens and you lose a bunch of money, obviously it's on paper, but it's real in the sense that that's where it is. And you get jangled, you make bad decisions. How does that help you? So people that talk about cash being trash or whatever, they don't think about the psychological variable, the comfort that it may give you to be able to act or not act, not be rattled by something that happens, right? So it's about putting yourself in as good a position as you can to make good decisions, in tough periods. So I don't really care. I don't care if I have cash and the market goes up. I mean, I understand what it is, but we don't know when something might come along and might trip that up. I'm not saying it looks imminent, because it doesn't, but that's I don't need to make as much money as possible with my cash, because if something bad happened, I don't know what I would get rattled and make bad decisions. So I'm putting myself in a position where I can be calm when the shit hits the fan.
Yeah. So what I'm hearing you saying is that you're paying a price to give yourself flexibility and latitude and protect yourself from your own potential psychology working against you. So every investor has to kind of do that for themselves, figure out where they're comfortable, where they're not, allocate based on their risk appetite, their circumstances. So a lot of wisdom in that for sure. Appreciate that. I want to ask one more question here. You got kind of famous for your shorting during the .com bubble. Mm-hmm. A lot of people are, well, let's just put it this way. You're in cash. You've got some, like you said, idiosyncratic specific investments.
I have about 35-40% cash. Okay.
Sorry, I didn't keep going back to that. But we've talked about maybe a reacceleration, a continuation of the bull run, but you haven't gotten, aggressive on shorting yet either. Are there specific things that you're watching for to lean one way or the other? In other words, get more risk on or to start looking for shorts?
No, I don't see how I would get more risk on, because the higher things go, the dicier it gets, and the big macro problems aren't going to go away. If some perfect idea fell into my lap, I might buy it and I might reduce my cash that way, but I'm not going to reduce it on some macro reason. I would need to stumble into something that, this fits what I'm trying to do, and I'm willing to part with some cash to own XYZ. What was the other part of the question? I lost my train of thought.
What might make you start looking for short positions in the other direction?
Right now, not much. I mean, I would need to, if I was going to be short because I thought something was going wrong with the passive bid, you need some indication that the amount of money coming in from new hires, employment, was not enough to offset whatever retirement money was going out, like baby boomers retiring, or some level where it wasn't a driver, and the news could take over and start swamp the passive bid, so to speak, and have the market feed on itself on the downside like it did last spring. I was short a few things, mostly for try to protect my my longs and my other things, my longs basically. So I would need that. In terms of if it wasn't for the passive bid, my rules on the short side, I used to say to myself, okay, is the Fed easing or tightening? Easing. It's it's more difficult to make money on the short side. Is the market hitting new highs? Yes, it is. Are individual stocks hitting new highs? Yes, they are. Are companies, do they go down on bad news? No, not always. Sometimes, but not always. So some of the rules that I use to get myself more involved on the short side would say not right now. So I don't have any reason that I want to, other than you look at the dopey valuations and the nonsense that passes for knowledge. But that's not a very good reason to try to make, short selling is not a religious, avocation. You're supposed to try to make money. And so I don't see the setup to try to make money doing it right now.
Gotcha. So you're not getting caught up in euphoria, but you're also not shorting because you don't see the opportunity for that either. I think maybe a good place.
I don't see how I can set it up to make real money and control my risk at the same time, because things are so crazy. How do you control your risk in this environment? It's like being short a .com stock in the .com craze. I didn't do that. I'd learned my lesson. I'd seen what happened in Japan in the late 80s. I was short that market too. And I learned the power of imagination and a narrative. That kind of stuff first started in Japan in the late 80s. So I still got ran over in 1999, but I wasn't short that kind of crap. I was short the suppliers to them. In the final year of the Y2K build-out, I thought, it'd be obvious that PC makers were headed, to zero revenues, effectively, not exactly. But they got carried away too. So I've seen how things can get when they get crazy, and you have to respect the madness of the crowds if you're going to try to be short.
Bill, I feel like I've learned a lot. I really appreciate the wisdom and the years of experience you have to back up some of these things. I want to end with this. We have mostly a retail audience and a lot of people who maybe haven't been in the markets as long as you have. Maybe, we're going into Q4 here. We're deep into it. The Fed's cutting. What are you spending most of your time paying attention to? What are you giving most energy to? What is most important on your radar as an investor going into Q4 that retail people might have overlooked and that they might need to pay more attention to?
I don't have a good answer for you because, I'm paying attention to my individual companies. I've told you what the things that would be my alerts for wanting to short. I have plenty of cash. So, I would get bigger in something if the right opportunity came along. I'm not going to get short unless something changes along the lines of what we discussed. So I think what your retail viewers need to do is they need to spend some time and understand the rules of the game we're in. That is the passive bid, and learn about that so that they'll be ready and to be able to deal with things when they start to go wrong. Instead of being blindsided because all of a sudden the market's getting blasted for some reason and you're having to panic and figure out what to do, you say, you would maybe see some of the signs coming along and be able to get somewhat defensive. That's what you should spend your time doing, understanding what are the driving forces of the market that are more powerful than anything else, and that's the passive bid.
I very strongly agree. I think education, community, sharing ideas, learning from others is the best thing to be doing at a time like this. Bill, really appreciate you coming on today. Where can we send people to find more of you and your work online?
I have a website called fleckensteincapital.com. I write a column every day. I've been writing it since 1996. And I answer questions, and it's $130 a year, which is, if you have a paper out, you can afford it. I refuse to do it. I give the money goes to charity. I don't pocket any. I do it because I enjoy it. I've been doing it long enough, and I find it helpful to me. I've helped other people. And so, anyway, that's where I am.
Bill, it's been a pleasure to talk to you. You're kind of a personal hero and legend in the space. So thanks for coming on Milk Road Macro. I hope we can have you again soon, but thanks for being here, sir.
Sure. Thanks for having me.
Absolutely. And thank you all for joining us. I hope you all learned a lot. I sure did. So until next time, stay safe, stay educated, stay bullish, and we will see you all on the next episode of Milk Road Macro. Thanks for being here, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.